Good evening, all the joinees. Thank you so much for joining in. Hi, this is Prajakta. I would like to warmly welcome you all on behalf of NGEN Research. So meanwhile others join, what we will do is we'll introduce our topic for today. So यहाँ पे typically today in the webinar we'll be discussing on understanding rolling analysis, where firstly we will understand the terminologies that are used in the rolling analysis tab of compare section on NGEN Markets. We'll first understand rolling windows. Next, we will understand the rolling returns distribution analysis, which will help us in understanding the range or the probabilities that each of the funds generate return in the client's target return range and what are those probabilities. Next, we will have a comparison as to how we can check rolling analysis, not just on individual funds, but also on portfolios. Finally, we'll throw the forum open for a Q&A session where you can get your questions resolved by either typing in the chat box or directly unmuting yourself to speak. So let us now begin. So today for rolling returns analysis, the sections that we will be focusing on are the compare sections and typically individual portfolio analytics. So let's go to the compare section and the second tab, which is rolling analysis. Now for doing rolling analysis, let me load in a fund. So let's consider a IPRU blue chip, so large cap fund. So I just search for that. So this is the IPRU large cap fund. So once I've loaded it, you take it in the rolling returns section. Now, you will see certain terminologies here. To start with, let us start with rolling windows. Now, what do we mean by rolling windows is the holding period that is under consideration. With what period that you would like to roll these returns. Typically, the rolling returns analysis happens on a daily frequency, right? It rolls with a daily frequency. However, the time period during which you want to roll this, that is what you will be specifying here, which is to say, in other words, holding period. So now when we are putting a rolling window as 520, or for that matter, anything in multiples of 260, that typically tells us what is the number of years we are considering the holding returns as. So if I put this as 260, that means I'm considering 1 year holding period analysis. I put this as 520, which means a 2-year holding period analysis. So I'll simply put this, one second. I'll simply put this as 520 and I'll click on run. Now the first data point, before coming to the first data point, let's come to the start and end dates that you see right here, which typically tell you in what time period or in what slot do you want to roll it every 2 years. Okay, so now let me consider a 5-year analysis. So I will check it from 2018, maybe December. And the end date is, of course, the current 21st December. So I'll take this as, let's say, 17th of December, and I click on run. Now, what this means is, if I consider the entire 5-year time period from 2018 to 2023, right? And I hold, maybe an investor holds on to it in any period of 2 years, right? The holding period is 2 years. Between this entire 5-year period, what would be the rolling returns that would be generated by this particular fund? So that is what we are analyzing here. Now let us come to the first data point and interpret what this line chart and these points that have been plotted really mean one by one. So I'm hovering on the extreme start point of this line chart, which typically says that, okay, IPRU blue chip fund on 14th December 2020 given a return of 12.38%. Now, how do you interpret this? If you see the start date, the first point is exactly 520 working days after the start date that you have put. So 17th December 2018, if you calculate 520 working days from that date, that comes to a 14th of December 2020. And that is why it has taken that as the first data point of this entire line series. Right? So from this, after this point, every single day you move in this line will give you exactly previous 520-day rolling returns analysis. So in this case, what do we interpret this as? For an example, if an investor would have invested exactly 520 days prior to 14th of December 2020, that is on 17th of December 2018, he would have gotten a return of 12.38%. And this is, of course, annualized basis. So if you want to check the entire 2-year holding period return, then what you can do is come to this methodology tab and change it to absolute. Right? There's a drop down that is given. You can switch between annualized and absolute. Now, the moment I click on absolute, these data points are going to change. You'll have to rerun it for the data points to change. Now you will see, again, go on the first point, which is again 14th of December, and now you can see the returns of 24.76. So these are cumulative 2-year returns from 2018 December 17th to 14th of December 2020. Now, if I were to interpret the highest return, then I simply hover on the extreme peak of this line chart, which is about this point, right? Which says that if an investor would have invested exactly to 520 days prior to 21st of March 2022, he would have gotten a cumulative absolute return of 86.07% from his investment into iProof Blue Chip Fund. Please note that these are absolute percentages that we are looking at because we have changed the methodology to an absolute, right? And conversely, the investor would have been unluckiest when the lowest return would have been 14.95%. Now, how do you locate that? Just simply hover on the lowest point. It would be somewhere here. And we see that, okay, this is the point in time when the investor would have recorded the lowest return. That is the interpretation of this high and low. Now, let us come to the average return, that is statistic that is available here. Now, if you calculate all the data points that you can see on this line series and take an average of that, that comes to this average return of a 38.60% over this entire 520-day periods from 2018 to 2023. So those are average rolling returns. VOL is volatility. So what was the volatility in these average rolling returns? So how deviating are these daily returns from the average return? So that is how we have calculated this volatility numbers. The high and low we just discussed. Now the range, what do we mean by range? Is that, okay, this particular fund can go as high as a 86%. It can stoop as low as a 14%. So therefore the uncertainty or the swing between that is a 71% data point. And that is what is the range that is mentioned here. Now let us simply consider annualized as a number and we'll interpret this further. Now, if you see the percentage positive, now what that means is if you divide the entire quadrant of all of these returns into simply two different quadrants, one being positive returns and one being negative returns. So by positive, I mean above zero, and the other is below zero, which in this case means every single data point, if we consider 2-year holding periods, have been in the positive quadrant. And that can clearly be seen here on this line chart as well. There is no data point that is falling below this zero level, which is the y-axis on this line chart. Right now, this is considering 2 years as the holding period. Now, let us check what happens when we change this to a 260-day, which is 1 year holding. So as typically said in mutual funds, right? So the longer you hold, your probability or your chances of making a low return definitely falls. Now we are moving in the reverse direction. We are reducing the holding period from a 520 days, which is 2 years, to a 260 days, which is 1 year. And I click on run. The moment I do that, look at that. So the lowest return is a negative 35.27. Now, how do we interpret this? Let us hover on this particular lowest trough on this line chart, and it is around March of 2020, typically COVID onset, right? So that means, what do we mean is that if the holding period is 260 days and the investor would have invested exactly 260 days prior to 23rd of March 2020, he would have been unluckiest because the return that he would have gotten is a negative 35.27. Now, this is with respect to the statistics that you can see in the tabulated manners here. Let us now come to the statistic that you can see right here. This is, you have an option to choose between point to point and simple returns. So let us understand the calculation methodology of both. So when I choose simple returns of, let's first understand point to point. So when I change it to point and I click on run, the change is in the methodology that is used to calculate this 8.02% returns. So in this case, I see that, okay, on 16th of December 2019, the return was 8.02%. Now, how has the system, or how have we arrived at this 8.02? The methodology that we have used is point to point, meaning we have considered the end NAV, end date NAV. What is the end date here? That's 16th of December 2019. So whatever the NAV was for iProof Blue Chip, we've considered that. We have divided it by the start date NAV. Now, what is the start date here? That is 17th of December 2018. We have divided the end price NAV, end date NAV divided by the start date NAV and just -1. So basically how compounding really works. And that is how we've arrived at this statistic of 8.02% return. That is point-to-point analysis. So whatever happened in between these two dates for the entire 260-day data points, these are not considered at all. Right? That is how point-to-point works. Now, the moment we change it to a simple return, you will see this number change. So currently it's 8.2. Let's change it to simple returns and I click on run. Now the data point, the first data point that you see is 8.93%, definitely different. So now to arrive at these simple returns, what have we used is, we have used every single day's returns and cumulated all of that up. So from 17th of December 2018, if you go on calculating daily returns until 16th of December 2019 and sum all of that up, that would come to a sum of 8.93%. So it typically takes into consideration each and every day's returns and cumulates all of that up. That is why we call this as simple returns and not compounded, or not it does not have a path dependency. So typically simple returns take into consideration the summation of the daily return sets. Right. So this is how these two are different. Now, if you want to actually check whether whatever we just discussed is actually working or not, the same can be replicated in an Excel sheet. So what we will do for that is, we will just load in iPro Blue Chip Fund in a new tab. And we will put in the same start date and just download the NAVs. So let's change in the start date to 17th of December 2018 by choosing here custom start date. 17th of December, and I click on run. Now, the moment this analysis gets run, you will see at the top, there is a download prices in CSV icon. You simply click on this and the daily NAVs are going to get downloaded. So let's open the Excel sheet. These are the daily NAVs of this particular fund. Now let us calculate how we really come up with point-to-point and simple returns. So look at the start date here. This is 17th of December. And the first data point on this line chart, when we consider first point-to-point, was a 16th of December 2019. Right? Now let's go to the Excel sheet again. So the statistics, as we discussed, was the end price divided by the start price. Now, end price is 16th of December 2019. Let's first locate that right here. So look at that. So the cell is relevant cell for the NAV is B262, right? The NAV of the fund was 43.93 on 16th of December 2019, which is the end price. So we consider this cell, which is B262, divide it by the starting NAV, which will be from the data point really started, right? So this is the starting NAV. And we'll do a -1. Convert this into percentage. Look at that. So 8.02%. And that is exactly what is coming in as the point-to-point returns, right? So this is how we calculate these point-to-point. We just consider the end price divided by the start price -1. That is how we come to point-to-point returns. Now, let us change it to simple returns and let's see what is the statistic. The statistic is 8.93% returns considering simple returns as a methodology. You go back on the Excel sheet, and this is, of course, point to point. Let's come to the second one, which is simple returns. For that, what we are going to simply do is we are just going to do a sum from the day of the daily return set. So daily return set meaning you can see the third column that you can see beside the price tab, which is the returns. These are daily returns. Now, how we have come up with that? So basically 40.67 divided by 40.52 and a percentage of that. So this is daily difference of 0.37% as compared to the previous date. So I simply do a sum. Just a second. So 262, right? So So basically what we've done is we've summed up all the daily return sets for the entire 1 year time period. 1 year meaning starting from, of course, 17th of December 2018 to ending, that is the 16th of December 2019, right here, till this date. And we hit on enter. Convert this into percentage. 1 second. So 8.92. You go back, look at that, 8.93. So this is how we've calculated the simple return statistics. And interestingly, these two statistics are different. That's because the point to point does not consider anything that is happening in this period, right? The change of this NAV from a 40 to maybe a 39 is not considered in between whenever it happened in March of 2019. It only is concerned with the end date and the start date and their respective NAVs. Now this we just saw for a single fund. You can add as many funds as you would like in the compare section and perform the same analytics on that. Right. Let me now just add in one particular younger fund in this case, and let's see how this rolling analysis really pans out. So let's add a quant large cap. This was, just launched about 1.5 years ago. I take quant large cap in this rolling analysis, and I click on rolling tab again. So now, if we typically see, if we would, typically now do a 2-year rolling, it will give me an error. Now, why is this so? That's because the start date or the launch date of this particular fund was, not covering the 520-day rolling window that we have really considered. That means this fund was not around for a 520-day period. And that is exactly why we are getting this error. Now, this does not mean that we are doing something wrong. It's just that the period is not, enough for calculating this rolling analysis. As you can see, the fund really launched on 12th of August 2022, and that's why this is the start date that we are supposed to consider. It's not 520 days after that. So what we do is we change this rolling window to a 260 days, which is 1 year, and then we click on run. And you will see these data points coming in. Now, the blue line that you can see is for iPro, and the black line is for quant. Again, the methodology or the calculation methodology is the same. I just highlighted this so that you realize that the NA error is not something as a problem. It's just that the overlapping period is not there. So basically, we've written that specifically in this question mark as well. So the minimum common time period of the data has to cover at least the rolling window, right? So they have to be the funds that have been around for a time period that you're considering the rolling window. So you see now the data points are here. The first data point is 11th of August 2023, which is exactly 260 days from the start date. And the last data point is right there. That's yesterday's NAVs. So this is how you can understand rolling returns interpretation, the entire statistics that we were just, that we just understood right now. Now let's come to rolling returns distribution analysis, which is the second part. Now, rolling returns distribution, it typically helps you in classifying the entire data, that is the returns data of each of these funds, into 5 different buckets. So you will see in rolling returns distributions, there are 5 buckets. This will be calculated as one bucket. This will be considered as one bucket. This is the second, this is the third, this is the fourth, and this is the fifth. Now, the ranges that you see right here are taken on the basis of the lowest and the highest. So if you see in these two funds, the lowest range is of 6.28. That means there is no data point that is below 6.28% return of any of these funds, right? Therefore, this has been picked up as the lowest or the starting interval of this bucket, which is 6.28%. Now, the highest interval, that means the highest range, will be calculated on the basis of the highest return back tested by each of these funds. So in this case, that's a 22.48%, which is by iPro Blue Chip Fund, considering a 260-day rolling window between 22 and 2023. So just about 1.5-year time period, right? And that has been captured as the highest or the upper interval of this last interval. Okay, and now whatever you can see numbers here, these are the probabilities that each of these funds have given returns in the target return range or the return range that is visible right here. Now, let us interpret this. So for an example, if we consider a return range of 12.76% to a 16%, which of these two funds give higher probabilities in this particular return range. So we see that iPro has a probability of 44% of generating returns in this 12 to 16% basket. On the other hand, Quant has a probability of generating only 12% in this particular return basket. Right? Now, the utility of this is you can specify the target return range as per your client's requirement. For an example, let's say you're analyzing some large cap funds, right? I am just going to tick on large cap. I click on close. I put in some basic parameters, like let's say 5,000 minimum AUM, minimum ages, let's say 5, minimum Sharpe ratios, let's say 0.5. Once this is done, I click on apply. So these are 3 or 4 funds. One second. I'll reduce the Sharpe ratio to 0.40. So we have at least some fair bit of funds. So we have 7 to 8 funds. Now we take all of these funds in the compare section by clicking on add top 50 to compare. What we are doing here is we are understanding the utility of rolling returns distributions, right? All of these funds have appeared in the compare section. You go to rolling returns. In this case, the rolling window is a 260 days. That is 1 year. A time period is, in this case, 13 years. Let's restrict it to 5 years. So December. And I click on run. Now what I'm going to do is, let's say my target return range of the client is anywhere to generate a return between, let's say, a moderate level of a very conservative level of, let's say, 7% to as high as, let's say, a 50%. He wants to know which of these funds will have higher likelihood of meeting his target return range. Then what you will do is you will just put in his target return range in either of these baskets as I have just done. So 7% to a 50%. Now this means he does not want a single return which is below 7%. At the same time, he does not even want a single data point or return which is over 50%. Hypothetical scenario, but let's consider this as a scenario. Right? So between 7 and a 50%, these are the probabilities that each of these funds are going to generate returns, considering 260 day, which is 1 year as the holding period. Okay. So in this case, I see Franklin has the lowest probability of meeting my client's target return range. Therefore, I would rather avoid recommending a Franklin for this particular client because it has lowest probability of meeting the client's target return range. On the other hand, I have a iPro and a HDFC, which have one among the best probabilities. 68% is the likelihood that ICICI will meet the client's target return range. And 67% is the probability that HDFC is going to backtest, rather has backtested between a 7% and a 50% client's target return range. So this is how you can use rolling returns distribution analysis to effectively pick and choose funds from either one particular category or diverse categories. So that is also possible. Right? So this was rolling returns distribution analysis. Now let us come to single fund rolling returns analysis. So the methodologies or the jargons are going to exactly remain the same. It's just that when we do it on a single fund or when we do it on a portfolio, we can compare a side by side for a 260-day period, 520-day period, 780-day period, whatever period you specify, you can compare it side by side at one single place. Okay, so I've just loaded in iPro Blue Chip, as you can see, and I'm going on the rolling returns tab, which is right here. The moment I click on this, the statistics are going to be the same. So basically the periods that you can see are coming from here. So 260 days, which is 1 year equivalent, 520 days, which is 2 year equivalent, and 780 days, which is 3 year equivalent. So we are running rolling returns analysis simultaneously on 3 different holding periods. Again, we have an option to choose between whether you want to see this data points as annualized or absolute. Currently, I'm putting this as annualized and I'm clicking on run. So now this means that with a 260-day time period, that is 1 year holding returns, the average returns are a 16%, and those really go on increasing as we increase the holding period to a 3-year period, that is 780 in this case, right? The 3-year average rolling returns from this particular fund is about a 19.35%. And look at the lowest return. So typically, as the holding period increases from a 1 year to a 3-year period, the lowest that this fund can ever go, right? The losses typically vanish. The lowest return is also a 12% positive. This was negative 35 with a 1 year holding period, and that was somewhere here, typically during the COVID time, right? And this got really flattened out when the holding period increased to a 3 year period. Now, this is not really hard coded. Basically, you can change this. Let's say you want to do this for a 6 month period or maybe for a 5 year period. So that is possible as well. You just have to edit these rolling windows and multiply 260 days, which is equivalent to 1 year, with whatever number of years that you want to analyze. So let's say you want to do this for a 4 year period. You multiply 260 by 4, that comes to 1040, and you simply edit this and put it as 4 years. Right? You want to do it for 5 years, 260 multiplied by 5, that's 1,300. And you put 1,300 right here and you click on run. So that's how you can compare for varying time periods, holding periods simultaneously. This is single fund analytics. Similarly, the page will be visible for even portfolio analytics. Let me quickly load in a portfolio. So we go to the portfolio section and run a portfolio. This is a 9-fund portfolio. We're currently running this from 2018. Let's run it from 10 years, and we will see how we can change in the rolling periods. So let's say 2nd of December. Now what we are really doing is from 2nd of December 2013 till 21st of December 2013 is the time period that we have taken. This is a 10-year time period. Now in this 10-year time period, we are rolling the returns of these portfolios for varying time, with varying time frequency. So let's keep 1 year as constant. Let's change the second window as, let's say, 780, which is 3 years, and the third window as a 5 year, which is 1,300. Change it to annualized and I click on run. So look at that. So basically, this is 260 days, which is 1 year. This is 2 years, and this is 3 years. So this is how rolling returns can be interpreted on a portfolio level, as well as on a single fund level, as well as on a list of funds that you would have loaded in the compare section, basically peers level. So you can add in a benchmark there, you can add in a category average there, and compare this rolling returns analysis across its peers from the same category, or even for funds across categories. So that's possible. So that's about it from my side for the topic related discussion. If you have any questions, please feel free to type in the chat box or directly unmuting yourself to speak. Thank you.
Hello. Can I ask a question?
Yes, please go ahead.
If you have been investing over a period of time in your particular fund, say over a period of 3 years, you have done an SIP, how the rolling return will happen?
Sure. Well, see, when you're looking at SIPs, rolling returns will only apply to the price of the fund. So with an SIP, it's just a different method of investing, but you're investing in the same thing. Now, so the rolling return, technically speaking, will not look any different for an SIP versus a lump sum, because you're investing in the same asset. In which case, I mean, you will be getting a different return personally, because you have invested over different periods of time. But whenever we conduct rolling return analysis to see how a fund is doing, SIP versus lump sum isn't really a consideration, because that's just your, it's money management. I mean, technically speaking, if you have the money now, there is no reason to do an SIP instead of a lump sum,
No,
unless you
okay,
believe the
even
price
for a
will
lump,
fall.
can I clarify my question? Even
Yeah.
for a lump sum, suppose I've been investing over a period of 3 years, and I
Sure.
have made 3, 4, 5 lump sum investment. Now, when
Right.
I do the rolling return, my
Mhm.
first investment start date will be different, second investment start date will be different, third investment start date will be different. So how do
Yes.
I do the rolling analysis?
Well, you wouldn't do a rolling analysis of your own returns. You would do the rolling analysis of whatever that fund is. So the point here is that when you're doing a rolling analysis, you're not doing it of your transactions, because what you've described here is your own transactions, where you bought some today and you bought some a year later.
Yeah.
And the return you therefore had, because you invested in different times, isn't really going to translate into a rolling return series, because for us to conduct rolling returns, we need we need a simple, stable series of returns, which is basically the NAV of the fund, which is unaffected by your investment strategy. So whenever we are conducting rolling returns, it's always on the security itself, not on your transactions.
Thanks. Thank you very much.
No problem.
Okay. This is Rajshekar here. I
Yes.
have put the question in the chat also, but let
Yeah.
me explain that I'm speaking. See, I mean, she was showing this 520 days rolling over the last 5 years for ICICI Blue Chip. The yield is straightforward. I mean, that calculation is very straightforward every day. And when daily returns, we'll look at it, and then, for every 2 years, the average of the returns and the average of all these returns over the last 5 years will be
Yeah.
the yield.
Mm.
How do you do volatility? And let me give the background of my question. I'm asking this because the volatility figures that you show whenever the rolling period increases is is very, very small. I mean, at least that's not what we are used to in any equity.
Yes.
I mean, normally the volatility will be almost equal to the mean returns of,
Yes.
or sometimes even it is higher than that also, but at least around mean returns. And this figure of 6%, 7% really looks, quite low. So what is the physical meaning of, that volatility figure, if there is any?
Yes. So, Prajakta, let's just go to a single fund. If you have any, you have one open there, and go to the rolling tab. So, yeah, here, this is the volatility number, which is the second row on the top, right at the top, right here. Firstly, this number should not be confused with this number. Yeah, just go there with the standard deviation, right? Because the thing is, let's go back to rolling. This rolling is showing you the standard deviation of 260-day returns over time, right? So basically, Prajakta, let's just make it absolute. So yeah, so then everything makes sense, right? Okay, so basically, so this is showing you the volatility of 260-day returns over time, right? So sometimes these numbers will be very low, and if these numbers are low, that's a good thing, because this means that the 260-day period or the 520 or 780-day period isn't that volatile. So you know that you're not going to get a very massive range when you're looking at a 1 year holding period, where sometimes it's going very high and sometimes it's going very low. So as you can see, for example, in the 520-day period, the volatility is lower. It's also because the high and low are not that extreme, right? And as we go to longer periods, you can see the higher lows become less extreme, because of, obviously it's a longer period of time, and over time, this fund is just generally doing well. So the volatility of 780-day periods is lower. But this number should not be compared to the fund performance number, which is basically the standard deviation of daily returns, annualized.
No, okay, okay. And also the period is different here. I think the year you are showing it from. Uh, oh, it's still the same period? Okay.
No, this will be the over the same period, but it is the standard deviation of two very different things. So that's the reason that they
Okay,
can't should not be
from
compared.
an investor perspective,
Yes.
the experience that, see, at the end of the day, we show standard deviation as the risk of the
Yes.
um, if, from a feeling perspective, what we are trying to explain there is, look, your actual, what you are going to receive can be plus minus 3 standard deviation of the mean return. So it can fall anywhere here, and this is how we explain. So basically, he gets an understanding that this number indicates, how much range in which my actual returns I am going to get is going to get affected. So there is some feeling there. Now, with
Yes.
this rolling volatility, what type of interpretation can I do?
Okay. So you can apply the same thinking. You can apply the same thing. There's one. It's let's say one standard deviation away to the average 1 year period. In fact, 1 year period is probably not the one we should use. Let's use.
I would prefer a 3-year period for all equity funds. So let's
So
take the 70 days and also make the don't put this absolute. I mean, we rarely use this absolute.
fair enough.
We-
So let's change to annualized. Let's change to annualized. So basically, if you look at the 520-day period, you see that 19.3. That is the average annual return for all 2-year periods. So on an annualized basis, if you hold this fund for 2 years, that is the average annual return that's coming out. It's pretty good.
Return
Right.
is straight. I mean, even the Excel sheet calculation is very straightforward. So we get that.
Now
It
the
does-
6.67, yeah, the 6.67 below that, that is showing you how variable that 19.3 is, because the 19.3 is the average of many numbers, and those individual numbers are there on the chart on the left. So if you look, like Prajakta stopped at 30th November 2023, the 2-year annualized return was 13.03. But sometimes in January 22, you can see it's very high. It's almost 40%, right? Now, so the question is, it's nice to see that over a 2-year period, there's an annualized return which is so high, 19.3. But what's the guarantee? Like, am I going to get near that? Am I going to get low, higher? 6.67% is showing you how volatile that 19.3 is. 19.3 is right now, but it was something else different earlier. That 19.3 is the average, right? Right now, the number is also again just below 20, you can see on the chart. But this 6.67 tells you how variable that 2-year annualized return is. And in the same way that in the earlier case, when we were looking at just the fund performance, the standard deviation was telling you how variable the fund's return is.
Right.
That's
Right.
showing you how variable the fund's 2-year return is.
Okay. Okay. So
Can I ask a clarifying question?
Please.
You said it is a 19% return average,
Mhm.
and volatility is 19.3 and volatility is 6.67.
Yes.
So I can take it that minimum I'll get it is 19.3 minus 6.67, and
Well-
maximum I'll get it is 19.3 plus 6.67.
Well,
Is that
not
the
yeah.
interpretation?
No, well, that shouldn't be the interpretation, because standard deviation, even the way standard deviation is calculated, is if you look at all the 2-year returns, if you put them on a Excel or something like that, what you do is you calculate the average. In this case, the average is 19.3. That is what you're saying. And on the chart, you can see the number is sometimes almost 10, or sometimes all the way up to 40. So we have all these different numbers. For every single point, we calculate the deviation from the average, which is how different is that number from 19.3. So basically, in this case, 43.04, where Prajakta is hovering, 43.04 minus 19.3. That's the deviation on that day. And we calculate all the deviations on every single day. After that, we take an average of those deviations, which is why it is called standard deviation. Standard means average. Deviation is what I just said, every data point and how away it is from the average. So basically, we take all of these numbers and subtract 19.3, which is the average. And then whatever the subtraction is left, which we're calling the deviation, we take the average deviation. So 6.67 says that on average, the 2-year return is 6.67 away from 19.3. So if you are saying 50-50 up or down, then you'll say half of 6.67 above 19.3, half of 6.67 below 19.3. That is kind of your volatility implied range.
right. Just the doubt is, will that really get that low? I mean, it's really very good. I mean, if I say someone should, if you hold it for 3 years,
Yeah.
on an average, assuming that the future returns will be on the same lines as the past returns,
Yes.
over this period of time,
Hmm.
it has been average 19.35%, but the chance of this actual return being away from this is just 3.27% away. I mean, that will be
I know it sounds low, but Prajakta just put the
almost guaranteeing.
yeah, I mean, the returns on this fund are pretty solid. right? That's what these numbers show, that over a longer holding period, this fund is actually quite consistent. So Prajakta, just click on the 780 on the chart. You put it off. Yeah. So, and then turn off this 520 and the other ones. Yeah. So here you can see, on the left-hand side axis, you can see this entire 3-year returns are moving between 15 and 30% approximately, right? Some once it came below 15. But generally speaking, any 3-year period you take, looking back in the past, it has given you between 15 and 30%. Average is 19.35. That makes sense. Here you can see high is 29.88. So it did give you 30% once. And then the worst case was 12.4. So this is actually true, right? Now, whether it's going to happen over the next 3 years, I don't know. But nobody knows. Even the fund manager doesn't know. But the point is, if we're going to judge them on the basis of what they have done so far, they've done an incredible job, because this is, this is a excellent annualized return that they have been consistently delivering for a while.
Yeah. Okay. Yeah, all right. If I can take it that far to conclude, then it is really, very good there.
Absolutely. Prajakta, just scroll up. I forgot which fund is this. Not bad. Yeah.
Chip fund, yeah, it's a large cap fund. Okay.
Oh, by the way, even according to our score, I hadn't realized this, but this is the top scored fund in its category.
Okay. Yeah, that will be my add-on question. You can answer it later though. Is
Yeah.
first time I mean I've been using it regularly, but I never looked at that your score there. I just wanted to know if there is an application note or something like this, on what basis and on how you give a number. It would help, or you can even explain. That's also okay.
Yes, of course. I
That is an
mean,
add-on question. But let me go to the next question that I have on this topic, so that it doesn't get digressed from this topic. Um, if you, on the rolling returns only again, if I see it over the same period, I'm just curious. I can also check this afterwards, but if you are anyway doing it very faster than I do. If I do it in the compare section as well as in the individual fund rolling section, how do the numbers look like? I mean, do they come same or?
if we, of course, so just make the start date the same. Take these guys out and put that fund. ICICI Blue Chip is already.
We can take the same fund. Yeah, yeah. Yeah, it's more to understand conceptually.
So ICICI Blue Chip, they will be very, very, it should be very, very close. So go to rolling. I'm pretty sure on analytics we use simple returns. So do analyze and simple and run it. Okay, so let's do 520 so we can compare with the middle one we're looking at. 0.3, there you go. So we've been able to match it. 6.67. It's the same thing.
Okay, okay. All
Right?
right.
We've been able to match it. That's an individual view. This is a group view where you can have others also. So this also, just to confirm, simple returns is what we use in the individual screens and in everything else.
Yeah, I also use it. I don't know this point to point is. I never
Yes.
use that. And I don't know how interpreting and explaining something to the investors is very difficult with that. Analyze is easy.
Yes.
All right. I was just curious when she was explaining, that question came to my mind, so I just typed it over there. So
Of course. And absolutely, they should match on both sides because it's doing exactly the same thing and there is no reason for them to not match.
all right, that's fine. So when we do, I think we'll just use it in one section and then use that data as it is. So
Exactly.
cross check that at the fund level again.
Exactly.
All right. Yeah.
Hello.
Thank you. Yeah.
हेलो
Go ahead.
या थैंक यू। जरा अभी आपने बताया था जो 6.7 को कैसे निकाले वो तो मुझे क्लियर है, पर
हाँ जी।
6.67 डिनोट क्या करेगा फिर? क्योंकि जब स्टैंडर्ड डेविएशन है तो वो तो हम कर नहीं सकते कि इतना ऊपर इतना रिटर्न आ जाएगा, वो तो हाई लो का और उसका हर रेंज का लेके हमने ये निकाला है, दैट्स क्लियर। तो एग्जैक्टली अगर हमें 19.30 एवरेज है और वॉल्यूम जो है 6.67 आ रहा है तो डिनोट क्या करता है?
देखिए ये डिनोट ये करता है कि ऑन एवरेज ये जो आपका 2 ईयर का रोलिंग विंडो होल्डिंग पीरियड है,
हाँ,
इसका डिविएशन फ्रॉम 19.3 ऑन एवरेज इज 6.67। सो अब जो डिविएशन मैं बोल रहा हूँ, डिविएशन ज्यादा भी हो सकता है, कम भी हो सकता है।
ठीक
तो
है।
और इसका कोई आइडिया इस नंबर से नहीं मिल रहा कि ज्यादा होगा कि कम होगा। बट अगर हम सारे डिविएशंस को काउंट करें कि पिछले 520 पीरियड में, या 2 महीने पहले 520 डे पीरियड में, या 8 महीने पहले 520 डे पीरियड का डिविएशन फ्रॉम 19.3 से ये कितना अलग था, ये सारे नंबर लें तो ऑन एवरेज ये 6.67% अलग था। सो
एग्जैक्टली। पर
हाँ
सॉरी, मैं आपको मैंने इंटरप्ट करा, पर मैं ये कह रहा हूँ कि इस फिगर का फिर कोई रेलेवेंस तो रह ही नहीं जाता ना, क्योंकि हाई 43 है और
हाँ
लोअर -34 है।
जी,
करेक्ट। तो फिर इस उस सिनेरियो में इस सॉरी 7.47 है, तो उस
जी।
सिनेरियो में 6.7 बताना एक्स्ट्रा, इसका फिर रेलेवेंस तो कोई रह ही नहीं जाता।
इसका रेलेवेंस होगा क्योंकि जो हाई और लो आप देख रहे हैं, प्रोजेक्टर,
हाँ,
लेट्स गो टू द इंडिविजुअल स्क्रीन वेयर वी कैन सी द चार्ट। आप देखिए ये हाई एंड लो, इसका
हाँ,
रेलेवेंस बहुत ज्यादा है मैं बोलूंगा,
हाँ,
क्योंकि
हाँ कि
क्योंकि
-35 आ रहा है, लो -35 आ रहा है, हाई 67 आ रहा है, और
ठीक
एवरेज 16 आ रहा है, तो वहां पे हम कहें कि वॉलेटिलिटी 17 है, तो इसका
ठीक
बताने का भी पर्पस क्या रहा फिर?
पर्पस ये रहा जी कि यहाँ पे आप देखिए, इसका मतलब ये है कि अगर आप हाई मानिए 67 है और लो -35 है,
करेक्ट।
तो इससे ये लगता है देख
हम्म,
के, ये अगर आपको सिर्फ मैं यही नंबर बताऊं कि एवरेज 16 है,
हम्म,
बेस्ट केस सिनारियो 67 है, वर्स्ट केस सिनारियो -35 है, आपको लगेगा बाप रे बाप ये तो कुछ भी हो सकता है,
ओके।
राइट?
हाँ,
क्योंकि ये तो लॉस भी हो सकता है। पर
कर
एक्चुअल में आप देखेंगे जो हाई है 67 या लो है -35, यो एक दो स्पेसिफिक सिचुएशंस में ही आया है।
ओके।
ये लो 35 तो आया है कोविड के टाइम, ये तो लग रहा है वो लॉकडाउन जब हुआ था,
मार्च
राइट?
20 का होगा तो, हाँ।
और वहां से ऊपर फिर वो पूरा जो लॉस रिट्रेस किया उसी में इसने 67 कमा लिया। तो मैं तो बोलूंगा ये 67 फिर से कभी नहीं होने वाला, मुझे तो नहीं लग
हम्म,
रहा, राइट? अनलेस
हम्म,
समथिंग हैपेंस, ना ये
हम्म,
-35 होने वाला है अनलेस समथिंग हैपेंस। तो
हम्म,
जनरली स्पीकिंग हाई एंड लो तो कभी ना कभी आप इडियोसिक्रेटिक इवेंट मान लीजिए, या एक मतलब वंस इन अ ब्लू मून काइंड ऑफ इवेंट होगा जब ये नंबर आ चुके हैं पास में। बट
हम्म,
17% है वो आपको जनरली बताया, जनरली स्पीकिंग मोस्ट ऑफ द टाइम क्या हो रहा है, क्योंकि ये 17% एवरेज है ऑल ऑफ इट। ये
ठीक
जो
है।
67% जो है इसका डिविएशन काफी है 16 से,
हम्म,
-35 है उसका भी डिविएशन काफी है। उस
हम्म,
डिविएशन नंबर ने इस एवरेज को थोड़ा सा बढ़ाया होगा।
हम्म,
बट लेकिन अगर काफी सारे -35 आते हैं हमारे पास, या -20 -10 -15 आते हैं, तो ये
हम्म,
वॉलेटिलिटी बढ़ जाती है ऑब्वियसली, बिकॉज डिविएशन काफी सारे बड़े बड़े डिविएशन आते हैं हमारे पास, और उनका
बिल्कुल,
एवरेज फिर ज्यादा होता।
बिल्कुल।
तो ये 17% आपको ये बता रहा है कि ये ऊपर नीचे होता है लेकिन उतना नहीं होता जितना
ओके।
रेंज से देख रहा है। तो
हम्म,
इसका वैल्यू है।
ओके। तो मतलब यह है कि अगर हम एवरेज 16 बता रहे हैं और वॉलेटिलिटी 17 बता रहे हैं, जो कि
जी
लोअर साइड के ऊपर है, तो
जी,
16 आने के चांसेस अच्छे हैं। हाई लो को हम उसको इतना तवज्जो या उसको इतना कंसिडर ना करें ठीक से।
उतना कंसिडर नहीं करिए ये, मैं
हम्म,
बोलूंगा और इन्फॉर्मेशन है कि चलो आज तक देखें वर्स्ट या बेस्ट सिनारियो हुआ क्या है।
हम्म,
बट 67 को कंसिडर करना इज लाइक सेइंग कि मेरे दोस्त ने लॉटरी जीती है तो मेरे को भी मिल
हम्म,
जाएगी, वो
हम्म,
मोस्ट लाइकली नहीं होगा।
हम्म,
तो इट्स अ वन टाइम इवेंट हो गया था। एंड अगर ये बार बार होता है 67,
हम्म,
तो एक तो आपका एवरेज हायर होता पक्का,
बिल्कुल। पक्का,
और
पक्का, हाँ।
वॉलेटिलिटी भी हायर।
हम्म, हेलो।
हाँ जी।
हाँ जी, अच्छा, ठीक है, ठीक है। नहीं, एवरेज तो अगर 67 बार बार होता, एवरेज तो हाई होता, वॉलिटिलिटी तो फिर कम हो सकती थी। हाँ
देखिए
कि हाँ, ज्यादा ज्यादा सर, ज्यादा ही ठीक है।
बिकॉज डाउन भी तो होंगे।
हाँ, डाउन, करेक्ट। ठीक है सर, समझ रहा हूँ सर।
थैंक
तो मतलब एक तरीके से जैसे हम लोग पहले क्या करते हैं, वॉलेटिलिटी को ना, एक हम जैसा अभी राजशेखर जी ने कहा, हम इसको ना बैरोमीटर मान लिया करते थे। इतना प्लस करिए उतना इसके बीच में रह जाएगी। पर वो
हाँ
चीज
जी।
सोचना हमारा गलत है इसका।
देखिए उस तरह से सोचना मेरे हिसाब से सही नहीं है, बिकॉज
हाँ, हाँ,
वॉलेटिलिटी आप देखें भी तो लार्ज कैप की एक सर्टेन वॉलेटिलिटी है। अब वो,
हाँ, हाँ,
जब मैं वो वॉलेटिलिटी बोल रहा हूँ, आई डोंट मीन दिस वन, आई मीन जो फंड परफॉर्मेंस में आपको सामने दिख रही है। right? और actually project, yeah, go to the compare section. वहाँ पे अपने large cap fund अगर जैसे हमने डाले थे, आपको दिखेंगे standard deviation. अच्छा ये रही, यहीं से दिख जाएगा. अच्छा ऐड कर दिया, ठीक है. तो standard deviation आप देखिए, यहाँ से आपको kind of relative performance मिलेगी कि ये अपने सारे large cap funds हैं जो प्रयोक्ता ने filter डालने के बाद आप देखिए 17-18 के आसपास है, राइट? अगर मैं आपको सेम वे पे, आप जो पहले बात कर रहे थे, मैं इनका लो एंड हाई भी दे सकता हूँ, डेली रिटर्न लो एंड हाई, और उसको एनालाइज कर सकता हूँ. बहुत आगे पीछे आएंगे वो नंबर्स, बट दैट डज, हम लोग तो स्टैंडर्ड डिविएशन देखते हैं यहाँ पे ना. ये स्टैंडर्ड 17-18% ठीक ठाक है फॉर लार्ज कैप. लेकिन कल को फिर मैं अगर एक स्लाइटली लो वॉलेटाइल टाइप एसेट क्लास को देख रहा हूँ, तब मुझे वॉलेटिलिटी कंप्लीटली अलग तरीके से देखनी है. तो वॉलेटिलिटी मैटर करता है, बट मैटर करता है, बहुत मैटर करता है, लेकिन कॉन्टेक्स्ट आपको हमेशा चेक करना पड़ेगा, क्योंकि काफी लोग बोलेंगे 18% वॉलेटिलिटी बहुत ज्यादा है, मुझे नहीं चाहिए इतनी. अगर आपको नहीं चाहिए तो आप लार्ज कैप मत करो. तो वॉलेटिलिटी इज एक्चुअली एट द एंड ऑफ द डे जस्ट डिस्क्राइबिंग एक प्राइस सीरीज कितना ज्यादा वेरिएबल है.
बिल्कुल.
तो ऑब्वियसली आपके जैसे डेट फंड्स होंगे, उनकी वॉलेटिलिटी कम होगी, बहुत कम होगी.
बहुत जीरो की बराबर.
वो कुछ कर ही नहीं रहे, हर दिन थोड़ा थोड़ा बढ़ जाते हैं, तो ऑब्वियसली वॉलेटिलिटी बहुत कम होगी.
थैंक यू, आपका बहुत टाइम ले रहा हूँ मैं.
No problem. Any other questions, please let us know.
If there are no questions, you can just briefly explain that score.
आपने बहुत अच्छे ब्यूटीफुल तरीके से समझाया. ये पॉइंट हमें बहुत पहली दफा इतना अच्छे से क्लियर हुआ है आज. थैंक यू
जी. हम हर फ्राइडे को यहीं पे होते हैं 4 बजे, तो आप मोस्ट वेलकम. Sorry, did you ask for some explanation of the fund score?
Yeah. I mean, on what basis is arrived at?
So the basis behind the scores are two main. One is return and one is risk. So first, I clarify one thing: we are not looking at holdings. So which fund is buying any stock, what we are not bothered with that, at least in our calculation of fund score. So the way we came up with this fund score is we looked at various different methods, and we applied those methods to the to historical data, and then historical data up to 1 to 2 years ago only. So we basically wiped out 2023, 2022, 2021 from our database completely, and then we created fund scores up to 2020, 2021. And then with those fund scores, we tested with what probability were these fund scores actually forecasting good funds over the next few years, which is 21, 22, 23. So in that way, we were able to say which is a good method to score a fund, so that it is able to, at least do a decent job in forecasting which fund will do well. And what we found is that the simplest methods are the best at forecasting. The more complications we add, the more it becomes like a process of chasing our own tail. So what we've come up with is we look at few different windows for returns over the past. And minimum a fund that needs to have return is about 5 years to have a full score. So we do score younger funds as well, but the younger funds will have a lower score just because they don't have 3-year returns, 4-year returns. So quant large cap doesn't mean it's a bad fund at all. We're not saying that. We're just saying that this is not done its time like the other funds have. So I'm sure the returns are good, they look good. But again, we're not saying this is a bad fund. We're just saying it's a new fund, so it will earn its score over time. And really, there is no way out of this. If a new fund comes in, no matter how good it is, at the end of the day, it does not have a past, does not have a history, and that counts for something. So when we calculate scores, we look at over the last 5 years, we look at various different periods of returns. In the same way, we also look at various different periods of volatility. What kind of standard deviation have they provided? What kind of risk characteristics have they had? Taking these two things into account, we come up with a risk score individually where only risk is considered. And we come up with a return score where only return is considered. And then finally, we come up with the fund score, which is the one that you show everywhere, which is an amalgamation of the two. Now, one thing that is very, very important with when looking at these scores is that you should remember that these scores apply to the category only, which means that this category that we're looking at, large cap, the highest scored fund is, I think 8.27, this one. Yeah. So this is the best fund in large cap as of last month end, because every month end we will update these scores. And this is how it score. The score of this fund has shifted up and down on the chart, you can see. But this only applies to this fund versus others in the category, right? So if you are, so you should not compare the return of a large cap fund and its score with a return of a small cap fund, right? But having said that, there is a bigger benefit of scoring in this way, is that if you go to the screener, here, now in categories, you got large cap, let's add mid cap and small cap. Yeah, and a couple of others also is fine. Now you see here, we want a diversified portfolio where we can see, let's say many different scores across, different categories. When we sort it like this, Prajakta here, just use the setting icon and put the category in. Yeah. So here you can see one small cap fund is a very high score, a couple of mid cap, one large cap, then more mid cap, small caps, etc. So we are getting funds from different categories, but high scores. So that means we are picking out the best funds from all these categories. So this is a really nice way of, first, you can decide which categories you're interested in, select them, and then just sort by the fund score. And the ones that you find on top will generally be very, very high performing funds within their own category. Now, if small cap as a category is going down, let's say for argument's sake, all small cap funds are going down and they're all negative, and all large cap funds are going positive, it still will give you a high score for a small cap fund if it's the one that's losing the least amount of money within its category. It doesn't mean it's going to perform better than a large cap fund. That depends on the category performance. So here, this picks you out the best funds from each category. So it becomes easy for you to create a diversified portfolio, and you can rest assured that you've picked the best funds in each category. So that is the main purpose of this. The main purpose is that it will really help you create portfolios, diversified portfolios across categories very, very quickly. And it's something we will use in future updates when we come up with portfolio creators, etc.
Okay. Okay. So just to get a quick view of its relative position in that particular category, we can go and take a look at this number.
Absolutely, absolutely. Here, and very quickly, you can you can just see where it is versus all other funds.
Right. Okay.
Hello. Okay.
Yeah.
Can you hear me, sir?
Yeah. Please go ahead.
Could you go back to ICICI blue chip funds rolling return?
Sure.
Yes. What can you go below?
Yeah.
And what does this indicate?
Sure. So this is a single view of the distribution ranges. So what this shows is, on the top.
No, I got that the probability.
Yes.
Yes, but right. In the right column that you have mentioned, rolling volatility stats.
Okay. Those. Yeah. Fine. Sorry, I thought you were.
Yes.
Okay.
So the numbers given above and below are not matching. So what does this indicate? Is it something different?
Yes, it's completely different. So the numbers above and below will not match. This is a very it's not used by too many people, but I believe it's actually very important, because this in the same way that we are doing rolling returns to see how consistent returns are over holding periods, what we also need to look at is how consistent volatility is. So before we go to this Prajakta, let's just go to the fund performance page and just highlight the annual volatility stat, 17.58. So when you look at this fund, you calculate standard deviation of its NAV and you get 17.58. And you may be happy or sad with that number. But what is more important, this number is as of today. But you want to know, how does this number move, right? So in the past, how high was it? Does it come lower? So you can see now, for various different holding periods, how is the volatility going up and down over time? So, this is a rolling analysis of volatility, not of return. In fact, none of this has anything to do with return. This is further analyzing volatility, right? So this is standard deviation over time.
Okay.
Right? And this is the average standard deviation across all 260-day periods. This volatility, this is actually a second derivative, because this is the standard deviation of rolling standard deviations. So 6.73 is showing you how volatile is the rolling volatility.
Okay.
And high and low. So sometimes volatility has gone up. That 17.58 number we saw earlier, sometimes it has gone as high as 30%, right? And sometimes it has dropped as low as 8%. So when we look at that 17-18 volatility number, we should know that over time, it can go up and down a lot.
Okay. Understood. Thank you.
Any other questions? Please let us know.
Yeah, this is not a question, but just a comment on the question that I had asked on email. That has been clarified. I'm happy with that. In the debt funds, that whatever durations you show is actually a modified duration.
Right.
So, I mean, in that case, should we not change the heading? I mean, is that possible? Change the heading to as modified duration?
Yeah.
Yeah, because all the standard textbooks, most of us use that Fabrozzi book for bond mathematics.
Right.
Duration, he means always Macaulay duration.
Fine.
So I mean, I don't know if anybody else asked this question, but at least it confused me for a while. And then, and of course, the difference will be very small between them because the YTMs are generally very small in this case, which is the differentiating factor between the two. But it just from a quick understanding, if it is shown as modified duration, then people may not have any doubt.
Absolutely, we'll do that. In fact, Prajakta, let's write this down. And what we can do is we can also show Macaulay duration right next to it. So both of them are visible.
Oh, yeah, it is available. Yeah, why not? I mean, that will be another interesting thing. Yeah.
So we have the YTM. Just a question for you, sir, is we show you YTM here. Do you care that we take the TER out of the YTM before applying it to the formula? Because our net YTM, the second column that you see here, that is basically YTM minus TER.
Right.
So in your opinion, should we be using the net YTM or the regular YTM?
No, strictly by the definition of bond valuation, it has to be YTM. Net YTM is our usage for indicating it to our clients.
Right.
Here keeps varying from fund to fund.
Yes.
Purely from a bond definitions point of view, it is the YTM that matters there.
Fair enough. So Prajakta, let's just write this down. So we'll change the name and then we'll introduce the second duration as well.
Yes, sir.
Yeah, thank you so much. I mean, anyway, my doubt was clarified by the email clarification you have given. I just thought.
Yes, sir.
A doubt came in my mind. I can just put it to you in case anybody else asks also.
Absolutely. Thank you so much, sir.
All right. So yeah, thank you very much. I mean, I could not attend for a few weeks, but after some time I came and it was very useful too.
Thank you, sir.
I'm doing this regularly, but every time I attend, I learn something different. So
thank you, sir. And we do put these up on our YouTube channel. So if you are interested, if you have some free time, then please just you can go there and all the recordings are up to date over there. So you can forward and go to the relevant sections. All the webinars are online on YouTube.
all right, fine. Yeah. Thank you very much. I mean, this is a good facility here.
No problem. Any other questions? Please let us know.
Maybe none, I guess.
Yeah, that's fine. So Prajakta, we can close for today. Thank you.
Thank you.
Thank you very
Thank you.
much.
Thank you everyone for joining in. You can definitely check our previous webinar recordings as Arav sir really just mentioned. Have a great weekend ahead and thank you so much for joining in. And lastly, wish you all a very Merry Christmas. Thank you.
Thank you.
Thank
Same to
you.
you. Same to you.